Hello. In this video, we'll be going through permanent differences. We've learned so far that the net income for or revenues and expenses for financial reporting may be different than what's actually reported on a company's tax return. And we've also learned that up to now that those differences may be temporary, which means that it's not an issue of whether an amount is taxable or deductible, but just rather the timing of it is different between the books, which is the financial reporting, and tax. So if it gets reported here and not here, then in the future, those things will be reversed. So that's what we've learned up to now. If you have questions or don't understand what temporary differences are, there are several videos all about deferred tax assets and deferred tax liabilities that I encourage you to watch. Now we're going to go into what are permanent differences. And permanent differences are transactions or events that occur which are reported for financial reporting, but get reversed for tax purposes on a permanent basis. It's not just a timing issue that you'll never get taxed or they'll never get deducted for tax purposes. So let's take tax-free income. So sometimes a corporation might buy a state or municipal bond, and in exchange, the corporation receives interest revenue generated from that bond. And so for financial reporting, they will do debit cash, right, for whatever amount, and credit interest revenue for those amounts. And that revenue will increase your pre-tax book income. Well, for tax purposes, that revenue generated from a state or municipal bond, there's a tax rule that says that does not get taxed. So that will automatically be reversed on the tax return on a permanent basis. It won't be recognized as revenue at any point in the future. And that's what we mean by a permanent difference. It's really permanent between your pre-tax accounting income and your taxable income. There's lots and lots of different items that can cause permanent differences. I'm just going to kind of highlight some of the more common ones that you would be seeing on a tax return. We just talked about interest received from investments in government bonds. Now, I just want to point out these are state and municipal bonds, not federal bonds. If you take the CPA exam, they might try to trick you like that. So any premiums paid for life insurance policies on key officers of the corporation. So if the company pays for life insurance policies for their key officers and the company itself, the corporation is the beneficiary, then those payments are not deductible. So think about the corporation will debit insurance, life insurance expense and credit cash, and so that expense reduces your pre-tax accounting income. Well, for tax purposes, that expense is added back into income on a permanent basis. You'll never get that deduction. However, if a key officer does die and the company is the beneficiary of that policy, any life insurance proceeds that the company receives will also not be taxable. Another common permanent difference are fines and penalties due to violations of law. When I worked at a big pharma company, they got assessed a $600 million penalty from the DOJ for marketing off-label or non-FDA label approved medications. So they were FDA approved, but just not for that specific indication. And so there was this big $600 million expense for financial reporting that the company was not allowed to take as a deduction on their tax return. So that was a really big deal. And so there's just like all kinds of different permanent differences that are out there that could impact taxable income. The good news is that the accounting for a permanent difference is a lot more straightforward than deferred taxes, because all you have to do is calculate your taxable income times your tax rate, and then you have your income tax payable, and that's what you record. There's no deferred component to it. There's a thing called effective tax rates, and permanent differences affect the effective tax rate. Let's talk about what it is. The effective tax rate is your tax expense divided by your pre-tax accounting income. And when you have a permanent difference that reduces pre-tax accounting income, or really it should say reduces your taxable income on a permanent basis, that'll increase your effective tax rate. And when you have a permanent difference that increases your taxable income, it should say will reduce your effective tax rate. It says here pre-tax accounting income, and it's really just how you think about it, but I like to think about it that increases taxable income, not pre-tax. Let's go through an example. Medina Land Management reported pre-tax accounting income in 2027 of $105 million, which included $5 million interest from investments in municipal bonds, and the enacted tax rate is 25%. So let's calculate what our tax payable should be. We have our pre-tax accounting income of $105 million. So included in this $105 million is $5 million of interest from municipal bonds. We know municipal bonds are not taxable ever, so we're going to remove that $5 million from our taxable income. So our taxable income is only $100 million times 25%, and then we have to pay $25 million on our tax return. So we still go through that 4-step process that we've been dealing with for tax accounting in every single one of these videos. And that's step 1. Yeah, you calculate your current income tax payable, which is $25. So we credit income tax payable or liability for $25. Step 2 is calculate your ending deferred, which we don't have, which means we don't have to calculate our difference between our beginning and ending deferreds. And step 4 is plug to the income tax expense. So we would have a debit to income tax expense for $25. Now let's look at I should not have that there. Let's say Medina Land reported pre-tax accounting income in 2027 of $105 million, and there's no book to tax difference. Like whatever your pre-tax accounting, that's going to be your taxable income times 25% would make my tax payable be $26.25 million. So I would credit income tax payable for that amount. I have no deferreds, and then step 4 is my plug to income tax expense. So I'm going to have a debit to income tax expense for $26.25 million. So let's see how a permanent difference impacts the effective tax rate. So when I had $5 million of municipal interest included in my $105 million, my income tax expense, so the effective tax rate is going to be your income tax expense divided by your pre-tax accounting income. That's the formula. So when I had $5 million of municipal bond included in the 105, my income tax expense ended up being $25 million divided by 105 million. So my effective tax rate is $23.8 million. And you can see that here in my 105, and I excluded my $5 million of municipal bond interest, and my tax expense was a debit of $25 million. Now, what happened to my effective tax rate when I didn't have any municipal bond included in the pre-tax accounting income? Well, then in that situation, my income tax expense was $26.25 million. My pre-tax accounting income still has not changed, but my effective tax rate increased by to 25%. So you can see the permanent differences have an impact on your effective tax rate. Now let's go through an example where we have temporary differences and what does that do to effective tax rates. So let's take this example where my pre-tax accounting income is $100,000, and included in this $100,000 is $20,000 of revenue. That's an installment sale basis, but we're not going to recognize that revenue for tax purposes until we actually receive the cash. So we're going to remove that $20 from our pre-tax accounting income, and gives us our taxable income is $80. at 25% makes our tax payable $20. So step one is we're going to record income tax payable for $20 credit. Now that $20 that we have not been taxed on in 2028, we're going to say we've received the cash in 2029. And so we need to set up a deferred tax liability because we have a future taxable amount. So we're going to set up the $20 at 25%. Step two is calculating your ending deferred tax liability, which in our situation is $5. And then step three is you take the change between your beginning balance and ending balance. So now we're going to have a credit to deferred tax liability for $5. And then step four is the plug to income tax expense, which would be a debit of $25. Okay, so now we've this temporary difference of we had pre-tax income of 100 and we had this temporary difference in there of $20. Now let's pretend that this full $100 is just made up of regular day-to-day sales where those revenue items are recognized for tax purposes in the same accounting period as it does for the accounting income. So we have our book equals tax. Oh, this should say taxable income. So our book equals tax. So our taxable income is $100,000. Our enacted tax rate is 25%. And our income tax payable is $25. That's what we're going to owe on our tax return. Step one, record our income tax payable. So we're going to credit that amount for $25,000. Step two and three have to do with deferreds. But in this situation, we have no deferreds, right? We have no temporary items because our book income equals our taxable income. So then step four goes to plugging in the income tax expense for $25. So let's see what happens when we have temporary differences and how that impacts our effective tax rate. So when we had our effective tax rate, when we had installment sales, right, included in our pre-tax book income, our income tax expense was $25 million and our pre-tax book income was 100. So our tax rate was 25%. And when we had no installment sales and our book income equals our taxable income, we still had $25 million of income tax expense and still $100 million of pre-tax, and our effective tax rate remains the same as 25%. So the whole point of this whole analysis is that permanent differences, when we have permanent differences, they impact the effective tax rate, and temporary differences have no impact on the effective tax rate, no impact. And that's kind of proving that point. On a 10K, companies are required to disclose a reconciliation that shows why their effective tax rate differs from what it would have been based only on federal statutory rate. So really it's the federal statutory rate on corporate tax return is 21%. So what it's saying is if your effective tax rate is not 21%, you need to list out the items that make it fluctuate. So any major permanent differences, and there's material permanent differences, and there's a definition to what constitute material permanent differences. State and local taxes could affect your effective tax rate. Tax credits or changes in the valuation allowances also are items all that impact the effective tax rate. But these items are all kind of more like advanced tax. So for right now, we're just really focused on the permanent differences. Now, most likely, when you are actually preparing a tax return in the real world, you're going to have permanent and temporary differences. So here's an example. You have a pre-tax accounting income of $185 million. We have municipal bond included in here for $5 million. So we need to remove that interest revenue and that's a permanent difference. And included in the 185 is some installment sale income that we will recognize for tax purposes in the future. We're going to recognize $20 and $20 million in 2028 and $60 million in 2029. But when we're doing our current income tax payable, we're going to see all the items that affect our taxable income in the current year. So our taxable income is $100 million times 25%. gives us a tax payable of $25 million. So we're going to credit income tax payable $25 million. That's step one. Step two is calculating your ending deferred tax liability, which we have $80 of future taxable amounts that we're going to have to recognize, right? We have to recognize revenue for $80 million. Tax affected 25%. Our ending deferred needs to be $20 million. So we're going to credit $20 million as part of our journal entry. And then step four would be, again, just the plug to income tax expense, and that would be a debit of $45 million. So this is just to highlight how you would account for things when you have permanent and temporary differences. It's really no different. It's just up to this point we've separated everything. So I wanted to just kind of bring it all together.